Hi everyone, this is Demo Gonzalez of Heartwood Financial Services. Hey, thanks for joining us for our latest financial education video. Now today's topic is deduction lumping. No, that's not some sort of weight loss fad. This is actually a tax strategy that can help you save money in taxes. So if you like to save money, and especially if you are charitably inclined, this could be a good strategy for you to consider. Let's get right into it. Alright, so as always, the easiest way to explain what something is to give you an example. And right off the top, I also want to give a disclaimer here. I am not a CPA or an accountant, so do not treat this as specific tax advice. This is a general education on what deduction lumping is. The other thing I would add is that calculating taxes can be rather complicated, and there's brackets and everything, and so I'm using a more generalized way of calculating this just for illustrative purposes. So please give me a little grace. So here is the example. We have a married couple filing jointly. Their income is $200,000, and let's say they're tithing and they're giving $200,000 to charitable giving. And then they also have $10,000 in other deductions. This could be real estate taxes, mortgage interest, those types of things. So their total deductions is $30,000. All right, so in this scenario, we have $30,000 in itemized deductions. Now, for the year 2023, the current standard deduction for a couple that's married filing jointly is $27,000. So obviously the $30,000 is a better deduction than the $27,000. So in this example, the couple will most likely do an itemized deduction. Now, a couple at $200,000 in income, that's about a 24% tax bracket, so that's where I got these numbers here below. So you save $7,200 instead of $6,648 for an extra savings of $552. All right, now we have the same couple that's earning $200,000, and now they implement deduction lumping. Okay, so in this example, instead of doing their $20,000 in charitable giving over a 2-year period, what if they did it over a 1-year period and maybe give it in the first year or even in the second year? It doesn't really matter, but the example is that they do the charitable giving all in 1 year, 2 years worth. And then they also still have their $10,000 in normal deductions. Now you could possibly even pay ahead of time some of your real estate taxes and things like that, and maybe lump it even more, but I know that's not always possible. But in this example, now you have $50,000 in tax deductions in year number 1. All right, so let's look at the numbers here a little bit closer. So you got your $50,000 in deductions in year number 1. So again, if you assume that 24% tax bracket, that is a 12% or $12,000, forgive me, tax savings year number 1. Year number 2, you do not do any charitable giving, or maybe you reverse it, you do all of it in year 2 and you don't do it in year 1, right? So in this case, you're doing all in year 1 and none in year 2. So you only have $10,000 in deductions in that case, maybe even less if you pulled forward the real estate taxes. But anyway, here you have just going to take the standard deduction of $27,000 instead of itemizing. So again, $27,000 at 24% is $6,648 in tax savings. So if you add up the tax savings over those 2 years, it equals $18,648. If you just did the normal itemized deductions and did the same thing from example 1, you would have $14,400 in tax savings instead. So the bottom line, when you do the deduction lumping in this example, you save an extra $4,248 in taxes. Now that's over a 2-year period, but still, that's a pretty decent amount of money. And I think the example that I gave you, a lot of people might fall into that category. Okay? And so again, I did a general calculation for taxes. I know there are tax brackets. It's a little bit more complicated than what I presented, but I just wanted you to see the concept and understand it and talk to your accountant and CPA about if this is a strategy that can work for you. And this strategy also works really well with what's called a donor advised fund. It's basically an account where you can deposit that lump sum charitable gift and then give out of that account over the subsequent years. And so it's a way, so that way you don't have to give it all away in 1 year necessarily. You can give it to the charities over time, just like you normally do through a donor advised fund. So again, talk to your CPA, accountant, reach out to your financial advisor, or talk to me, and I'd be happy to explain a little bit more of how that works. But I hope this was helpful. Thanks a lot for watching, and God bless.